Hey everybody, Hunter Satterfield here, one of the partners of Kane Waters, as well as the Chief Investment Officer. As always, I'm joined by my good friends, Brian Bortz, my fellow partner and the head of our investment committee here at Kane Waters, as well as Brad Sanders, Managing Director of Tectonic Advisors. This is your June market update. For the month of June, the S&P 500 was down 1%. We will talk about what it's looking like for the rest of the year. Global stocks are down 0.6%. with domestic bonds up 0.2% and global bonds down 0.7%. So I'll definitely come to the guys because clearly the market doesn't just go up over time. Some interesting things as we look at the second half of the year, which Brian will talk about here in just a second. Through the first half of the year, the S&P's up right at 9%, with international stocks up 6%, bonds down 1%. But interestingly, small caps up 23% compared to the S&P of up 9%. So truly a fascinating first 6 months, very different than what we've seen historically. And Brad, I want to start with you just to sort of talk through, we saw some significant market broadening continue to occur in June, which is where we're seeing that, really the big gap between the lower part of the market versus the mega cap. So you want to double click a little bit more on the sort of the market broadening that's happened for the first 6 months?
Yeah, if you look at the equal weight S&P for the month of June, it was actually up 2.4%, and the cap weighted was down 1%. And what we're seeing in the cap weighted index, if you look at the Mag 7, which has been up until this year, the trend du jour, they're actually down high single digits as a group for the year. And what you're seeing is just all of the money that is in the hyperscalers and those Mag 7 companies has shifted to semiconductors. And so within the index, you've had the big Mag 7 stocks, which make up the most of the top 10 of the index, down for the year. But you've had the lower part of the index, the semiconductors, catch up in a hurry. But then at the end, it's the broader stuff in the index. You're basically just swapping dollars between these tech companies. And the broader stuff is where you're getting the growth push from. So I find that pretty interesting. It's trickling down into small and mid caps, as Hunter mentioned. And I think that's going to continue in the back half of the year. As we move into the back half of the year with the equity markets, I want to, not to be glass half full, but we have a new Fed chair as of May, Kevin Warsh. Historically, all the way back to 1900, anytime you switch Fed chairs, the market's down the next 6 months. It makes a little bit of sense because Fed chairs tend to stay on for a long term. And when you get a new guy in there, it's kind of like politics. You go from Republican to Democrat, or you go from hawk to dove, and you kind of switch policy 10 years in there. What's interesting about Kevin Warsh is he's kind of coming out and saying, we're not going to give dot plots, we're not going to give guidance. I actually think that's a very healthy thing for the market long term. I think the Fed has become beholden to these dot plots they give out since the global financial crisis. Like, hey, we said we're going to do this, we have to do it or we'll lose credibility. Well, I would argue you lose more credibility by sticking to these dots when you have like rampant inflation and you're not tackling that. And so by getting rid of that, the Fed's going to be able to be more nimble. So I think over the long period of time, it's going to be really good for the markets because the Fed's going to be able to be more reactive. But in the short term, the market's not going to like it. They like certainty. They've had about a 15-year period of knowing exactly what the Fed's going to do. As long as economic data hits X and Y, the Fed's going to do Z. That's going to kind of go away. And so the market's going to have a hard time to digest that, particularly with higher oil prices, higher inflation, and rate hikes on the table now because of what's going on, which we wouldn't have said prior to the Iran war. And so I think as we digest that over the next 6 months, you could see the market pull back. If you look at the median, we don't want to look at the mean because we changed Fed chairs right before the Great Depression and things that aren't on the table now. If you look at the mean, the market's down 8 to 10% over a 6-month period after you change the Fed chair, which I think would probably be healthy at this point to get a nice little pullback in the market over the long term. But then if you look at the 18 months after that, the market's up 100% of the time, and most of the time it's up double digits. So I think over the back half of the year, we might see some shakiness in the market, but just look at the long term. That means that, next year and into the middle of 2008, we probably have some more smooth sailing.
Yeah, super good. I think it's a good segue, Brian, over to you to talk about, we're halfway through. We've got this back half of the year, lots that Brad's already covered. What are things that we're looking at on the investment committee side of things and focused on for the next 6 months as we wrap up 26?
Yeah, if you look at the the thing that some of my clients have been asking about is, hey, is this market overvalued? And, right now the S&P is trading at about 21 or 22 times earnings, which is high relative to history, but that doesn't mean that it's overvalued. It just means that it's expensive right now. The long and short is what we're telling clients to think about is three key things for the second half of the year. The first one is inflation. What is the trend of inflation going forward? Do prices moderate? Do they continue to increase? Specifically looking at oil and gas and things like that that drive economic prices. The second thing is corporate earnings. Our corporate earnings continue to be strong. Right now, we have strong earnings, strong profits, strong cash flows, and that has led to a strong economy. And so really, if corporate earnings continue to be strong, then that's a very, very positive sign for the overall market in general. And then the last thing is kind of what Brad just alluded to a moment ago, is that the market leadership, that the stocks that are leading this market, do those continue to broaden out, or are they concentrated in just a handful of tech companies? And right now we're seeing that broadening, as Hunter mentioned, how well small caps have done. So really the three key things, again, inflation, is it moderated, strong earnings growth, and does market leadership broaden? Those are the things we're telling our clients.
Yeah, I think the way to think about this, this next 6 months, whatever happens, as Brad and Brian both talked about, is we have seen that diversified portfolios this year have performed very, very well. And so that's going to be the name of the game still in the second half of the year, no matter what we see from the Fed, from the administration, geopolitics, macro, everything else like that. So with that, we hope you have a wonderful July 4th with your families celebrating, and we'll be back in front of you at the end of July. Thank you so much.